Hi, I'm Juan Lee from LP Finance. I'll introduce two new concepts that LP Finance is bringing in to improve the current flaws of the synthetic asset protocols. So first, what is a synthetic asset? Synthetic asset is a tokenized derivative that mimics the value of another asset. For example, LP Sol is a synthetic asset of Solana and mimics the value of Solana. To create a synthetic asset, it should be over-collateralized, meaning more than the value minted should be locked as collateral to back the value of minted synthetic asset. As the process for user is supplying collateral and borrowing tokens, it is often compared to lending protocols. So let's see how synthetic asset protocols are different from lending protocols. First, synthetic asset protocol does not have a lender, which means borrow interest does not need to be paid. At the same time, the supply collateral cannot be lent to anyone, therefore supply interest also does not exist. As opposed to this, lending protocols have variable supply interest and borrow interest. Synthetic asset protocols tend to have a higher deposit fee as the protocol cannot earn profit from interest. Therefore, it will be hard to sustain the project without higher fees. Lending protocols provide rewards to borrowers and suppliers by liquidity mining, which reduces the borrow interest and increases the supply interest. As there are a lot of strategies advancing leverage, we cannot really determine which protocol has better yields. The main risk for lending protocols is that the variable interest rate might spike in volatile markets. Also, for synthetic assets, volatile market condition might cause the asset to depeg from its target value. So how do we improve the stability of synthetic asset price? On top of algorithmic burning and supplying, LP Finance is introducing Typeless Repayment for the protocol. As you can understand from its name, repayment can be done without fixed type. On LP Finance, there are options to borrow LPUSD or LP Sol. This amount can be repaid in USDC for LPUSD, and for LP Sol, Solana. If the debt is repaid in LPUSD or LP Sol, it is burnt. If the debt is repaid in alternative methods, the token is stored in the pool to back the minted synthetic asset basically forever. For repayment in alternative methods, the program does not calculate the US dollar value but the amount of tokens. Even if LPUSD and USDC has a price difference, if the same amount of USDC is repaid, the debt is cleared. This creates an arbitrage opportunity for users, which will bring the price of LPUSD and LP Sol back to its peg. Let's see how the arbitrage can be done. First, if LPUSD price rises above $1, let's assume LPUSD gains 5% premium, where 1 LPUSD is equal to 1.05 USDC. Users can borrow 100 LPUSD, swap it to 105 USDC, and repay debt with 100 USDC to take 5 USDC profit. If this arbitrage process continues, LPUSD price will fall back to $1. So what if LPUSD price falls below $1? If this happens, the arbitrage opportunity is not available for all users. Users with existing debt would have an option to repay at a cheaper price. Most users borrow LPUSD or LP Sol to swap it to other tokens, such as for leveraging long or leveraging short. So let's assume users swapped the borrowed token to other non-native tokens. Let's think about the 5% discount. So 1 LPUSD is equal to 0.95 USDC. So first, user borrows 100 LPUSD and swaps it to 100 USDC when LPUSD was at peg. So after LPUSD price falls to 0.95 US dollar, the user can now swap 100 USDC to 105.26 LPUSD to repay and take those 5.26 LPUSD profit. Even if this is not enough to draw LPUSD price back up to $1, users will be able to redeem collateral without any risks, and when mass repayment occurs, the price will rise back to its peg. So next, LP Finance has created a model to solve capital and efficiency problem with stablecoin, which will allow synthetic asset protocols to provide supply rewards to users. Let's get back to how synthetic assets are created. The collaterals are locked to back the value of minted synthetic assets. In this case, the required collateral has to be locked in the reserve pool. Therefore, the assets are not really used for any profit-generating events such as staking or supplying to lending protocols. To solve this issue, LP Finance created an Overflow Reward Model. In the design of Overflow Reward Model, LP Finance sets strict requirements. Even if the reward model is added, LP Finance protocol should be self-sustainable, meaning it should not require capital injection to maintain the reward distribution. Next, the reward model should be scalable, meaning the reward APY should stay similar even if the TVL grows, like 10 times, 100 times. Last, the reward model should not create hyperinflation. For example, if you were to mint our governance token to distribute rewards, it will create hyperinflation on the governance token, leading to a massive price crash. These requirements should be met in order to ensure that LP Finance can continue the service for years or decades. Now let's dive into the Overflow Reward Model. First, we have to think about the required collateral in the pool. If $100 of synthetic assets are minted, the reserve pool should have at least $100 to back the value. What if there are more than required, such as $150? So LP Finance allows access collateral or overflow collateral to be supplied to lending protocols to earn supply rewards. Let me introduce through the process. In the image above, there are two DAOs, which are CBS DAO and LP Finance DAO. Anyone who supplies collateral to LP Finance holds stake on CBS DAO without purchasing the governance token. As they supply their collaterals, they choose what to do with it. LP Finance DAO is driven by governance token holders, which approves CBS DAO's decision and takes the authority to make the final decision. We call this layered DAO. So first, CBS DAO votes for distribution on lending protocols. Not only one lending protocol is selected, but the overflow collaterals are distributed to multiple lending protocols in regards to their credibility and yields. Next, CBS DAO members vote for overflow ratio, which is the percentage of overflow collateral that are going to be supplied to lending protocols. Next, LP Finance DAO makes the final decision on CBS DAO's voting result. If it is confirmed, the approved amount of collateral are supplied to multiple lending protocols to earn interest. Of course, if there's a profit, there's a risk. First, if lending protocol exploit occurs, the funds are not recoverable. There is no backup or insurance if this scenario occurs. CBS DAO voted, therefore they're responsible for the loss. This will encourage CBS DAO and LP Finance DAO to be more cautious on their decisions. The next risk is lack of backing asset, which can be caused by the lending protocol exploit. However, this is not possible, as the required amount of collateral still stays in the reserve pool. Only the access amount of collateral was transferred to lending protocols. Minted synthetic assets are safely backed in any conditions. LP Finance will be operated in two sub-protocols, which are CBS Protocol Vanilla and CBS Protocol V2. On CBS Protocol Vanilla, supply and borrow interest is both 0%, but CBS governance also does not exist. Deposit fee is at 0.1%, which is relatively low. CBS Protocol Vanilla does not take any risks. However, for CBS Protocol v2, supply interest exists and is dependent on lending protocol rates. Borrow interest would be 0% and CBS governance would be present. Deposit fee would be at 0.5% and users would take bigger risk compared to CBS Vanilla. So we have gone through the new concepts LP Finance is bringing to DeFi and synthetic asset protocols to create a more sustainable and scalable system on Solana. Thank you for watching our video and check out our website to learn more about LP Finance. Thank you.